This is Mr. Additional Kazim Olani. I'll be taking you business finance policy and strategy too. Based on the outline, we'll be having almost 15 application of business finance. Business. But whether it is a one-man business or a partnership, it is important that you ensure the business does not run out of the money before it is able to deliver its product or services to the final customer. And in managing any company or project, it is very important to ensure that it does not run out of that money before it was time to sell its product or services and receive the payment. Now, what are the needs for adequate finances? For any business to working tools, and these working tools, sometimes they might be a kind of equipment, which of course required money to make all these equipment available. Like when we are talking of a woman that want to sell a fish or sell fish, so as to and carry out their business activities effectively. So, and this thing will require money to make them available. This is part of the reasons why we need money or finances. And these items mentioned as they are all referred to as capital, because the money that you need to use to acquire all these materials regarded as capital. And this capital, we are saying, they are the one that has to be used by the businessman in order to make things done so as to make the product available for their customers. Now, sources of finance. People seem to look out for banks as the only source of finance. No, bank is not the only source that a businessman or woman can lay their hand upon in order to start a business. There are a lot of sources out there, like building societies, merchant banks, mortgage finances, cooperative societies. This one is even common in our community here, that of cooperative societies. So, and the businessmen, they always afraid of going to banks simply because of the fact that so how do we now secure the loan? Secure what is loan? Loan are the amount of money or amount of finances which a businessman can co-owner of the business. So but some lenders always require security, that's collateral securities, so as to safeguard their funds. Parties or then share certificate of a reputable company like cars, jewelries, machineries, like the rest. Then the loan from friends, relations. Yes, one can get loan from the relations or from your relatives. So these types of loan might be cheaper because the collateral security may not be demanded or requested for, and at the interest at a time it is interest free, but somehow difficult to come by because the relative that you want to go and meet may not also be interested in giving it up, because if the business collapse, he may not be able to take you responsible. So this is a mutual understanding between the friends to assist one another with the finances so as to run their businesses with a stipulated time of paying back. So then we have the loan from commercial banks, as I've said earlier. The loan here are quite different from the loan from the friend, because the interest charged by the loan from the commercial banks, but the interest charge will always be higher, and the loanee needs to provide collateral security, as I've said earlier. So the bank's loans are saved. They are saved because they are very secure for both the loanee and loaner, simply because of the collateral security. So, like in this case of the bank loan, the interest are paid as at when due, while the principal sum are also deducted along the side with the interest. Now, contribution by the owners of the business, of course. Yes, when we are talking of the contribution by the owner of the business, there might be these are more or less equity than loan. That's what the quote money or forms of asset to start business, and the amount to contribute cannot be repaid by any other except in the event of liquidation of the business. The sharing of business. You have to identify the types of business, and is it a one-man business, partnership, or it is that you can know how could be shared. So if it is partnership, so that the percentage of money contributed by an individual or the co-owner of the business, it have more reasonable enough to start the business. That is the sharing of the cost. Now, sharing of the profit as well. Yes, the sharing of the profit is determined by the total amount of capital contributed to the business by the co-owners. And you should all know that the manager or the chief executive, but in that case, then sharing of loss, of course, if there is profit, according to the ratio of their contributions to the business. So the event when the business fall up, then they are only liable to the tune and amount they contributed in starting the business. So the liabilities of the business has nothing to do with their persons or their personal property. But it is only in this case of one-man business that the owner has to be liable to the extent of his personal belongings. That is the chapter 1. Then the chapter 2 aspect of that is the introduction to finance. Then what is finance as it is? Finance is not that only money that we use to start the business. No. But finance can be also termed as the process that it entails in order to acquire the fund, to make this fund we are talking about available, and how that money, that fund will be utilized. That is what they regarded as finance. Operation. It has to be to determine the optimal method of employing the fund. It has financing itself basically is the function in which a business that is responsible for acquiring funds for the firm. Now, when we are now talking of this firm, it can be defined according to a particular author. Finance as the administrative area of the set of administrative functions in the organization that relate with the arrangement as satisfactorily as possible. That is a single the first is the managerial capability that concern with the playing and controlling of the firm's financial resources. Because for every business, either small or big, have three financial resources, material resources, and human resources. So the next is the one we are talking about now. We have two kinds of finance functions. We have the managerial and this is required the controlling the and execution's ability of that businessman to manage the finance that are that is available. And the three important managerial finance, the asset means, financing decision, that is the capital means, allocations decision. So that is then the second functions of the finance is incidental or the incidental or the routine must perform, and they include the supervision of that cash receipt, the payment and the safeguard of the cash balances, securities, insurance policies, and other valuable papers, taking care of the mechanical details of new now when you are talking of the objective of the financial management, this it should be understood in the light of the objective of the enterprise as a whole. The following objectives are hereby advanced: the paid dividends. Then number 2 is maintain market price. Maintain the market price of the shares of the stock, and at the same time, number 3 is seeking the growth of the company, then avoiding high level of the risk. Avoiding the high level of the risk, then maximization of the profit and minimization of the risk. Then the needs to maintain some level of the control, that is the proper safeguarding and the utilization of the fund. Now, as I've said earlier, the objective of the financial management, why do we need to manage the finances? We manage the finances in order to determine how we are going to pay back the dividends. That is the contributions, the benefit that has to be given to those people that contributed immensely to the greatness of that organization, so as to achieve the objectives. So then, at the same time, we need to maintain the market price of the shares of the stock. So then, seeking the growth of the company as well. Then avoiding the high level of the risk, as I've said, and at the same time, the last but not least is the maintenance of the control, which is the proper safeguarding of the and utilization of the fund. Now, needs for financial planning. Why do we need to plan the finances that are available? Because the financial planning is a decision in advance that the financial needs of a business to achieve the basic objectives of the firm, which is no more than getting the maximum profit out of the minimum effort. Because part of the basic planning of every businessman is to earn a profit at the end of the day. So if you now want to make the profit, you need to minimize your what? You need to minimize your cost in order to maximize your profit. That is part of the planning. And in an enterprises, there must be someone who pull together, review and analyze the interpret and plans this requirement and the consequences. And this person that does this is the chief executive officer in charge of the finance of the enterprise. So when you look at the Jane of 2000, is an author. He talks about the financial planning that includes, it is as a result of the financial planning that we determine the financial resources required to meet the operating programs of the all the efforts. They are making effort in such a way that all the will play so to make sure that they make these things available is part of the determination and the planning we are talking about. And that they, without minding what exactly the qualities will come out of it. Then number two is to work out as to how much of the requirements are to be met by generating funds internally by the company and how much is to be obtained from outside the company. So it is as a result of this planning that will allow us either to meet the financial institutions or to meet the relatives, as the case may be, so as to determine. Because if you needed like 5 million, 6 million naira, the relative or the relations may not be able to give out such amount of money, rather than you meet your financial institutions. So that is part of the planning, because it is the financial planning that will tell you that. And at the same time, to develop the best possible plan for obtaining the to establish and maintain a for the then the formulation moves this uh, so that is that. So the relationship between the finance and other department of an organizations. As I've said earlier, it is very important to identify the relationship between the finance department and other departments in an organization, because it could be seen in the functions performed by the money or the finances. All the departments in the organization. So now the medium of exchange in almost all the transactions in an economy, money is the form of currencies or checks that perform the functions of medium of exchange, and it is used to pay for goods and services. The use of money as a medium of exchange promotes the economy efficiency by minimizing the time spent in the exchanging of goods and services. So the finance department is the source of keeping other departments running in terms of purchase and salaries of the staffs, and also encourage the specializations among the economic agents. So finance has eliminated the principle of double coincidence of what? Of want in an economy. Now, unit of account. When they are in the content of money as part of the function of money. So as a unit of account, the finance also play a role of unit of account. That is, it is used to measure the value in the economy. So people are ready to work and have their services value in terms of the wages that will be paid for them. So that is the value. And it will have been much difficult in terms of exchange of the services vis-a-vis the amount paid for the services. So, like when you enter a bus from Ojota to Yanapaja, you are meant to pay like 100 or 200 naira. So the services they render, rather than trekking from that Yanapaja to Ojota, so the services they render to you is the money that you paid in returns. So the department of organizations of an organization will function well and reduce the problems of quoting prices, quoting the prices in terms of unit of that money, rather than going around looking for who want what they have and have what they need. So the finance department restore confidences in other department of an organization, as money is being used as a unit of account, reduce the transactions cost in an organization. Now, store of value. When we are talking of the store of value, money also functions as a store of value, or that is the finances otherwise, as a what? As a store of value, because it is a it is a repository of purchasing power over the time. Over what? Over the time. And the store of value of money is used to save purchasing power from the time income is received until the time it is spent. And the finance department of an organization serves as an engine room which gives the lifeline to other departments in the organization as it solves their financial problems when one arises. So in that case, it is served as a store of what? Store of value. Then that is that about it. Then we have the finance, its operations, and the overall management of the corporations. Yes, the financial management is the skill that has to put forward by the managerial planning and control of the financial resources of an organization in order to achieve to achieve the objective of the business. Before now, of course, it was considered to be as aspect of economy, but it is now looked at as a separate discipline. However, it still draw the aspirations from economy for its theoretical frame. Now, what is corporate objective of the finance? The key things in business success is the definitions of the objective, which set in the motions the target to be achieved. The business firm are profit seekers, thus, and their goals, objectives, needs cannot be the same with organizations which are run to provide the social services to humanity, like federal, state, and the local government activities, which are meant to satisfy their subject, that is their citizen, the maximization of the profit. The ultimate aims of investment is to maximize the profit at a minimum what? At a minimized cost or minimum cost. So the businesses believe, eh, as long as they are increasing in the revenue while keeping the cost at a minimum level, they are achieving their objectives. So in the business as well, there are varying interests in the objective of the organizations, the shareholders, the societies, and the managers of the organizations. Yes, the shareholder will be expected to be given a dividend at the end of the day. That is the returns from their investment. While the societies at large will also be anticipating of buying the product that is coming from the organizations. Then the managers as well of the managers of the organization will also be expected to be paid the salaries at the end of this day. So at the end of the day, they will be paid their benefit. Now, for hello, my student. Yes, I want you to get this assignment done for you to submit before the next class. I want you to write short note or to discuss the shareholders and the management wealth maximizations. Critically discuss the shareholders and management wealth maximizations in relation to the finances. And that one has to be submitted to Adekas Management Consult 01 at gmail.com. ADE, ADE, KAZ, MGT, consult 01 at gmail.com. So you can send that. That is assignment number 1. Then assignment number 2. The assignment number 2, I would like you to also look at the types, source, and application of fund in the business environment. The types, the source, and the application of the fund in the business environment. That is the assignment number 2, which of course has to be submitted before the next class to Adekas Management Consult 01 at gmail.com. Now, before we leave for today, I want us to quickly rush down to the way of sourcing or raising funds for running a business. When we are talking of the way of sourcing or raising funds for running of a business, need for fund in a business, I think I've discussed that. Now, we have the classification of the fund sourcing.
This is the genesis of the videos and content I create. So, what is finance? As per my business school's textbook, which is Introduction to Financial Management by Titman et al., finance is the study of how people and businesses evaluate investments and raise capital to fund them. This can be simply put into context in two scenarios. Number one, imagine if you work for a company as an engineer who gets paid weekly. They understand evaluation and analysis of your paycheck and what you need to do with it may be called as looking for. Say if you own a business at a local market called, for example, I Happy Novelties, selling light-up t-shirts. The understanding, evaluation, and analysis of structuring a price point on business and corporation finance. I highly suggest you watch the video on my channel to thoroughly understand the difference between sole proprietors, corporation, limited liability. I will add a link in the description below. B is like my pet cat Raya, yourself to be a successful entrepreneur, or if you're studying for a school. Trust me, the concept you learn can be applied in your daily life once you start earning. Unlike stock terms, this means if I were to tell you, I'll give you two choices, and now you have to pick one of them. First choice, I'll give you $1,000 in a year from now. Second choice, instead of giving you $1,000 2 years from now, or a year from now, I will give you $100 today. Think about it for a moment. Although $1,000 in 2 years is nice, but there is something called as opportunity cost that you'll be foregoing. Hence, based on the principle, it's better to choose the money now than choose the money in the future. Remember this question as it shows up in a lot of test quizzes. Rule number 2, there's a risk-return trade-off. Now, using the same example above, I give you the same option, but add to you saying that rather than I give you the money, if you give me the money today, I'll give you an enormous return at the end of 1 year. Now it's really depending on the risk associated with the money and the trade-off. See if you're willing to forego $100 and believe in my business. Also, because the rate of interest is so convincing that you're willing to lose $100 on hopes of making 10 times the amount. That's the risk-return trade-off. Rule number 3, cash flows are a source of value. Normally, profits are an accounting concept which gives the performance of the business over time. Remember, profits could be projected value or real time, but does not guarantee you can take the money out of business. For example, for I Happy Novelties, if I sell a t-shirt with a cost price of $10 with a selling price of $30, my profit on that t-shirt would be $20, which is pretty good, right? What if from my profits, I need to pay the rent, bank charges, employee wages, etc.? So say, for example, I need to sell at least 5 t-shirts every day to cover for the charges, which is a break-even point. This value is a cash flow of the business. So cash flows are very important and hence a source of value for business. It is important that you understand clearly the difference between profits and cash flow, as we'll be discussing this in future topics as well. Rule number 4, market prices reflect information. This is more applicable to a public company, meaning the information of the company is available via secondary research, meaning available on a public domain. If you watch the stock market, as soon as companies' earnings come out, the stock price will fall accordingly. This is a good example of market prices. As per the financial management book by Tit Bennett, managers can expect their company share prices to respond quickly to the decisions they make. The book further states that a good decision will result in higher share prices. Poor decision will result in lower share prices. Lastly, rule number 5, individual response to incentive. This is a fundamental theory that you need to understand if you want to be a successful manager or entrepreneur or have a successful business. The explanation about agency theory and stewardship is extremely important, and I'll post a link in the description of the video that I made for another segment that explains this clearly. The part that you need to understand is that you need to motivate people to act on their behalf. For example, if you have a business, you need to ensure that the people are well paid and that their interests are well taken care of. Only then they will work on the betterment of the company. The principle states that the individual will keep their interest ahead of the company's interest. So as a manager, you need to reward them with incentives to maintain the balance. I really hope you enjoyed this video. I'll be posting written notes on my website where you can easily download it for your class or reference. Your comments and feedback are always cherished and welcome. I look forward to seeing you in another topic. This is
So thank you. That brings us to the end of the class. Thank you and God bless you all.